the rand recovered, of course, from 1 year lows of 750, which was hit in August, but charts suggest that we'll be continuing to see a bearish trend persist on this local unit. It's currently trading weaker than its 50, 100 and 200-day moving averages. What's your outlook for the local unit?
Morning, Alishia. Well, of course, the rand always performs badly when you have a situation as we have currently of high market risk aversion. So for as long as this situation persists, we see that rand bearish trend remaining firmly intact. As you mentioned, did weaken significantly. It broke through our initial target level of 717. We'd be looking for it to go perhaps 724 in the short term, maybe even as far as 730. And of course, this will continue for as long as markets remain volatile and highly risk averse. And of course, local data flow is not helping to support the rand either. Let's
take a look at that data flow, because we had Greg earlier touching on that business confidence numbers that filtered through yesterday, and that is certainly not encouraging.
No, not at all. Markets, I think all of us were quite shocked by how far business confidence fell in the third quarter. At its current level signifies that less than 4 out of 10 of the respondents are actually satisfied with current business conditions. So it's not entirely surprising considering the strike activity that we saw in the third quarter. And of course, the massive decline in business confidence was led by the manufacturing sector, which was hard hit by strikes, but also experienced quite a sharp slowdown in the second quarter as far as growth is concerned. So although the fact that business confidence declined wasn't surprising, it was the extent of the decline that I think took everyone by surprise. And business confidence tends to be a very good leading indicator for investment and investment intentions. So as far as that goes, it generally paints a very bleak outlook for this year and possibly even next year.
Certainly that strong rand has been a feature within the manufacturing market, where it's been debated as to, just how much less competitive it's making South Africa at this stage. In that context, we had all eyes on the SARB's reserves data today, and those figures have come in slightly better than forecast. What have you made of the data that's filtered through there?
Certainly, you're correct in saying that reserves data came out much better than expected. Gross reserves were up quite nicely, but largely a large portion of that is actually due to revaluation effects, mainly due to the fact that the dollar price of gold appreciated so strongly in August related to the market volatility that we saw. But we also had revaluation effects stemming from the fact that the dollar depreciated against the euro, and that helped boost FX reserves. As far as what the SARB actually purchased in the month, it does seem that they didn't. They purchased very much in line with their 3-month average that we estimate to be in the region of $300 million. It doesn't look like they stayed on the sidelines as one might have expected given the volatility in the market, but also it doesn't look like they stepped up reserve accumulation in the month.
Of course, that some of the local factors at play internationally. We saw yesterday's move lower on the local unit come through on the back of the Swiss National Bank's decision to peg its currency to the euro. It was a bold move that was taken. What did you make of it?
Well, certainly, as you mentioned, a bold move and one that I think took most people by surprise. We have seen a number of efforts so far from the Swiss National Bank to try and curb that currency's strength. We've seen them intervene in markets. We've seen them try and inject further liquidity into the economy. They've slashed rates quite aggressively, also in an attempt to weaken the currency or prevent it from appreciating as strongly as it has. And none of those measures have really worked. So now it seems that they've taken this last quite drastic step in trying to limit the franc's appreciation. As far as what we think, I mean, this is, as mentioned, quite an unexpected and drastic move. It does raise questions of what other countries may follow suit. Mm-hmm. We've seen banks like the Bank of Japan also intervening in currency markets. We know that Brazil cut rates recently in a bid to also try and stem the appreciation of the real. So if we have all of these countries starting to take moves to weaken their currencies, does raise specter of a recurrence of the currency wars that we saw occur last year. So certainly quite a move that has raised eyebrows, and we'll have to wait to see how it plays out from this point.
While we wait, we've seen the Bank of Japan out with its rates decision and pretty much in line with expectations, keeping its policy settings unchanged in a range of 0 to 0.1%. And it seems like the bank's decided that it's going to be keeping up its scant ammunition for later on in this game.
It certainly does seem that way. As you mentioned, they kept things pretty much unchanged, but with the recent move by the Swiss National Bank, there is an increased chance that we could see further intervention by the Bank of Japan. Last month, they intervened in the currency markets, and that was one of the biggest monthly interventions that we've seen since 2004. So it may be for now that they're content to sort of sit back and wait to see what the effect of that intervention has been. But certainly these recent moves that we've seen by other central banks does raise the possibility, or raises the chances, that the Bank of Japan could intervene further as the year progresses.